Hello, investors. Welcome to my channel, Since the 360 Investor, where we apply best practices from the companies that we invest in around the globe to the investing process. Investing is a complex affair, and here we build a framework for the retail investor to simplify the process. Before we begin, a quick word about the disclaimer. This is not providing financial advice. Please pause the video, read through the disclaimer, then continue. Okay, so without much further ado, let's get on with the show. Today, this video is going to focus in on stock analysis, and the company that we're going to look at is NFLX. The study was actually conducted a few days ago, November 21st. At the time, the price was $285.05. At the end of the week, it's now about $285.20. So no material movement in the price. Okay, so let's look at the company and what it does and how it makes money. So the business description, it's one of the world's leading entertainment services. I think that goes without saying. They have about 222 million paid memberships in over 190 countries. So the United Nations recognized 193 countries around the world. There are a few others. And most of its business is about video delivery, and their core strategy on the right hand side is to grow their streaming membership, because ultimately their business is built around membership, similar to Costco and their membership. How it makes money: the revenues are primarily derived from monthly membership fees. For those of you who do have Netflix services, they have a few different options, different pricing models that you can sign up for, from kind of a basic to slightly more advanced. And notably, two of their biggest offerings have come in the last 12 months. So RRR is a movie which is quite the rage on the internet. It's the biggest movie ever watched on Netflix or anywhere in terms of streaming, and is actually sort of won award in Hollywood, the Saturn Awards, possibly going to the Oscars next. And then Squid Game, I think most people have heard about Squid Game. It's a K-drama that was all the rage last year. And so those two have definitely put Netflix back on the map. Okay, so here's a new slide. I'm introducing this, and this from my MBA studies. This is basically Porter's Fire Forces with an additional force added on for regulations. Porter didn't have that in his original. But basically, this gives me a lens at the company within the industry that it sits in. So another day, I'll go through these some other time. But basically, the overall picture is the threat of substitutes, and this is what the competition coming in, or not so much competition coming. This is basically, as a user or a customer, can I go somewhere else and get the product or service that I want? So obviously that is high, but since there are a lot of places I can go, I don't need to stay with Netflix. Intensity of rivalry. So this is the new players coming on board, like Disney Plus, etc., all coming into Netflix's wheelhouse. Bargaining power of customers. So again, I have options. If Netflix prices being out of the model that, or how much I want to pay on a monthly basis, I can go to Hulu or Disney or ESPN, which is part of Disney, but any number of other providers. Bargaining power of suppliers. I've got this moderate to low because Netflix is reliant on kind of the endpoint delivery mechanism, so they need channel cable companies and to stream into the TV and internet providers to stream their services through those delivery mechanisms. New entrants coming into this industry are high. We're getting more and more players offering streaming services. Some are niche types, but there's obviously anybody coming in is potentially going to take eyeballs off of Netflix. And then government regulations are increasing, not just in the United States, but around the world, just because now they're bringing the video delivery service into internet issues in terms of what makes sense and how it's protected, and protecting certain parts in certain portions of the population from um, wrongdoings on the internet. Okay, so let's draw down a little bit deeper into using the SWOT analysis. So for Netflix, within the industry that it operates, it does have kind of first move advantage. It was, took out Blockbuster many years ago and pioneered started dealing with tapes, bulky VHS tapes, moved that into a DVD format, and then from DVD format, it's gone into digital, which is even greater cost efficiency. As a global footprint, as we saw, uh, they have intellectual property ownership since they are now into content creation. They have multiple foreign language offerings since they operate in so many different countries, and they have diverse workforce operating out of 60 plus countries or so. Opportunities for Netflix, there's an extension to games. So they are starting to get interested in offering online gaming, etc. They're also opening up advertising, which was not part of their initial business description. They wanted to be advert free, and they can continue expanding globally, although there'll be some challenges, and we'll look at that as well. Weaknesses, I mean, that last year or earlier this year, they had to exit Russia, which is a reasonably sized market for them. But there's also fallout from Russia sympathizing subscribers that may walk away from Netflix. And there is a seasonality to the Netflix business. Q4 is strongest through the holiday period. It does require large capital investments for content creation, since Netflix now it does create a lot of content itself. And then reliance on partners to deliver their services through point of delivery. Those contracts are typically 3 years, and they have to be continuously renegotiated. Threats, there's new entrants coming into the business. I mean, anytime a rich market is developed by anybody, then you do get competition coming in. So we've seen Peacock, Hulu, and also indirect competition, like TikTok isn't really in the same business as Netflix is, but it's because it's mostly shorts, but it is taking viewership away, potentially, right? So it is a competitor in that respect. And then anytime you have digital products, piracy is also an issue. A lot of the stuff can be pirated. And then there are, like I mentioned, TikTok, there's competition on other social media platforms as well as gaming, even though Netflix is now trying to get into gaming. There's increasing regulation they have to contend with. And there are other threats that people don't pay for the services. And then since it's an internet delivery business, then they're always going to be subject to cybersecurity issues as well. So that kind of drills down some of the challenges Netflix faces at a company level. So let's take a look at the governance quickly. So Reed Hastings, kind of founder, and now he's co-CEO, born in Massachusetts and went to school in Massachusetts, in a BA. So prizes a BA degree in mathematics. Would have thought that's more of a science degree, and so you can, but notably he also served as a director on Facebook and Microsoft. So he's got some good experience and served on boards of other well-known companies. I mean, serving on the board of Microsoft is a feather in his cap for sure. So good pedigree, good background, and he's done a good job overall at Netflix over the years. So what do you think, about Reed Hastings? Will you comment? Do you agree? I've added this new slide, and in future videos, as I delve further into, we'll look more into the other players as well. But for now, you can take a look through this. This is the rest of the team, and this is the salary that they're making. So I'll leave this here for now. Okay, let's take a look at some of the numbers, and I'm going to split this slide up as well, because these bottom three are really kind of management qualities, and we'll extend that. But over 5-year trend, revenues are up 26.2. Trend over the 5 years up, but and trading 12 months is also up there. So on the sell side, that's good. Earnings 68.4 in the last 5 years up. Now there is a mixed picture on earnings because some analysts are kind of marking down the EPS going forward for the near term. Cash Netflix was, because of the content creation, was burning through a lot of cash setting up the content creation. So it was being volatile. Over the last couple of years, it has cash flow has turned positive, but there was a big sinkhole for a while. Pre-tax profit margins up at 10.9%, pretty decent up, but there's been some pressure over the last trailing 12 months. Return on equity is very respectable, 24.9%. Trend is up, and debt is at 61.2%. So they brought that down a little bit, which is also a good sign. And then here we can see earnings per share kind of flattened out for a bit, and there's projected to come in before it starts moving up later in 23. And we've seen this big drop in Netflix's share price has really been cut pretty severely from 700 down to 200. I've quite lost value. It's up a little bit. This, I'm not going to get into the technical patterns, etc., but this pattern is kind of interesting for those of you who like to look at technical patterns. And then if we just look at the 5-year chart, so we can see it overall, it's been pretty favorable. And if we look at a year over year, 5 years, your returns 34.17% annually. And then if we look at 5-year trailing, so that's to the date 11/21, just going 5 years back from that, even though after the cut, it's still at 18.5%. Both these numbers handsomely beating S&P 500 average returns. Let's look forward. Okay, so in terms of sales, current year they're expected to come in at 31.59 billion, next year 34, so that's moving up. Earnings per share this year they're expected to come in at 10.32, next year 10.49, but there is a mixed picture here, so they're not coming out too far, and so some of the analysts have been revising the numbers down a little bit. Okay, so in terms of analyst sentiment, I've got a rating of -3, which is kind of on the edge of the lower range, where I would say it is still okay. So I would say it's kind of neutral to negative. If you just look at the recommendations, comes in at kind of a hold level at 2.4. Now price targets for the current year, we're looking at 270 to 287. Stocks currently trading at 285, so it's right there. Next year kind of stays pat, and then 5 years out, based on the growth projections, you're looking at 800 to 900 as a target. In terms of valuations, different models produce different results. So here's a few. First one came out 225, and the next one came out 223. Those are almost identical. Third one, which is the low man on the totem pole, at 171. And then discounted cash flow on this came in at 342, and we'll pick up on this a little later on in this video. Okay, let's look at a little bit more about tailwinds and headwinds. On the bullish side, Netflix boasts a strong portfolio, and moving into content creation puts them into a dominant position. It is investing in new regional products for the market, and that's where it's really driving its new subscriber base from. And then streaming regional products has basically been a strong tailwind in getting those subscribers. So on the negative side, it's becoming a very crowded market now. Lots of new entrants coming in, including non-direct players like TikTok, and then it's dominant home markets, both US and Canada, are kind of saturated at this point. The Russia exit impacts some of the European markets, so they lost some subscribers as a result of that. And the Asian markets, well, it's a large market, so those markets are price sensitive, so they're probably not able to do a lot with price over there, even though they'll pick up subscribers. So that's something that needs to be considered. And then last but not least, they have a pretty leveraged balance sheet. We saw they've been bringing it down, but it's still at high levels. Those debt and obligations need to be met from the cash that they generate. Okay, so company health, not going to spend a lot of time here. and this is for on this one. We'll come back to this later, but basically technicals are obviously red because price has been chopped from 700 to 200. Sentiment is not very strong. It's not negative either, so we'll give it kind of a neutral yellow. And governance, I've put the, even though I think Reed Hastings is an excellent CEO, the fact that he's now a co-CEO where there's no other person in the mix, it's always like, who really owns those decisions, and it's better to have one throat to choke, as we say in the business world. So I've given that a neutral kind of for now. Okay, so now decision time. And since Netflix does have a severe price cut, there's always the question of, is it a falling? Are you trying to catch a falling knife, or do we have a stock pick and we're getting some level of value? So current price is 285. The value price that came in at the models was 225, and obviously this price is still above that a little bit. Yahoo has it at fair value, which is kind of interesting. But Yahoo doesn't really stipulate what time frame they're looking at on this. And then if we look at the DCF, the discounted cash flow came in at 384, which is higher than the current price, giving you a little bit of a margin of safety around 25%. So this would kind of put it at fairly valued in here. And where it's currently at is maybe to the right of that, over here, slightly overvalued. So you can decide whether the price has dropped enough for you to be interested in Netflix, or whether you think that it needs to come further down a bit. Okay, so certainly be interested in your comments. Are you a buyer, holder, seller? Putting Netflix on your watch list, or you're going to pass on this, and whether you agree or disagree, please leave a comment. I'll be curious to see what your opinion is. All right, so that's a review of Netflix, and if you haven't already done so, please subscribe. That helps out. If you like this video, please click the thumbs up and share with your family and friends. Hopefully, if you feel inclined, leave a comment. So that's it for this video. Thanks for watching. Thanks for listening. I will see you on the next video. Goodbye.